All right, there we
All
are.
right,
We are
welcome to
live,
the show,
Tania.
everyone. All right, here we go. Welcome to the show. Let me do some quick introductions. I mean, if you are tuning in, you probably already know Rob or myself, but let's just do some quick introductions. I'm Tania Tetrault with the Tetrault Wealth Advisory Group at Canaccord Genuity, and today we have my brother and portfolio manager, Rob Tetrault. Today we're going to be answering your questions, anything market related, investment related, finance related. That's what we're here for. So if you're on our YouTube, Facebook page, all the socials, make sure you log in, comment, and send us some questions so that we can answer those for you. So, Rob, how's your week going so far?
Really good. Really good. I'm in the middle of the last week of my taper for the Chicago Marathon, which I will run this weekend. I've been building for this race for a while, so lots of heavy training. I'm dealing with an injury, so it's not going to be a great time, but I hope to be able to finish the race. So I'm excited about that. Chicago Marathon is one of the majors, so I'm pumped about that. I'm pumped about we have some new hires at the office. Gabe just started, associate on the financial planning side. The team continues to grow. Pumped about that. We celebrated some big milestones at the office recently as well. For the firm as a whole, things are growing. We just took on the new space. We have an extra, I think, 5,000 square feet that we had to take on just for all the expansion, all the growth we've had at the firm and at the branch here in Winnipeg. Our clients are doing well. So, I mean, it's a great time for me, I guess, to answer your question. It's been great.
It's a fun time of year. It's just so much happening, right? And events and all of that. Your training is always a little bit more fun than me, but I'll give you an update on my training. I recently got back into, which I was inspired by the Olympics. I used to do Olympic weightlifting. And after studying the Olympics, I was like, oh man, I miss that so much. So I'm working on my snatch and my clean and jerk. So not as exciting as you going to
that's exciting.
Boston Marathon,
hey,
but
did we talk about this yet when I was texting you about the Olympics, how I was so mad at the sport of weightlifting? I don't know anything about weightlifting, and sorry to get off topic here. We will talk today, right now, about the US Fed. We're going to talk about the election. We're going to talk about earnings. We're going to talk about all that. We're going to answer all your questions. And by the way, get the questions coming. We can't just, Tanya and I can't just do a soliloquy here for an hour without you guys' involvement. But I remember watching the weightlifting, Tanya, and I was so puzzled and upset that, someone lifted the weight. They had it above their heads. 1, 2, 3, dropped it. They lifted the weight and then no rep. They didn't give him credit for the rep because she wasn't stable, or I forget what it was.
Wow.
But
well, the irony,
you either lift the weight or you don't.
Well, yes
I don't
and no,
get it.
because
No, I disagree. If the weight is above a certain line, let's say 6 inches above your head or whatever, and it stays there for 3 seconds, that's a lift. I don't care if you didn't stabilize it. You lifted the weight. It's a black or white thing.
A lot of people would absolutely agree with you. And I'd say it's even more ironic and worse than you think, because usually when they give you a no lift, it's because you've done what's called a press out, which just means that you're, instead of getting under the weight over your head, you actually muscle it up, which is not as pretty, I guess you could say, from a lifting perspective. It's actually harder.
Yeah. Anyway, we're not talking about weightlifting for an hour here, but I wanted to. I remember you being nationally ranked or whatever in your weight class or whatever it was for weightlifting. So congrats for that. And now we're nationally ranked as portfolio managers. Yay.
All right. So we get to talk about the fun stuff now. Rob did mention we will get to all the stuff that everyone's asking us about, like interest rates. We're going to talk about elections. We're going to talk about earnings, all of these things. But obviously, we'd like to get to your questions first, if you have some. So if you want to post them on YouTube comment section, Facebook, any of the socials. I think we're on LinkedIn as well right now, I think.
Yes, I think so. I don't know. Twitter, I think.
Well, wherever you're seeing us, there's probably a section
where
you can ask some questions.
People going to keep saying Twitter?
I don't know.
That dies at some point. People will start saying X. Everyone I talk to still says Twitter. So I guess people should say X, but we're on X. We're on X. We're on Facebook. We're on LinkedIn. We're on YouTube. And if you're watching the replay of this, welcome as well. Welcome. And thanks for tuning into the replay. So still no questions. That's okay. But maybe we could talk a bit about the market. I don't know.
Yeah,
That's what we're here to
let's do
do, I
that.
guess.
Well, I think the thing that will come up the most often right now, top of mind, I would say top two things right now that I'm hearing a lot are either interest rates and the election. And I know those are two separate topics, but I feel like that is a lot of the on top of people's minds these days.
Sure. Where do you want to
So
start?
I don't know. Well, why don't we chat interest rates a little bit
Okay.
first, and then we can kind of segue maybe into how that might, impact other parts of the
Okay.
markets and things like
Let's
that.
start with interest rates. So what do you think people want to know? What should I
Well,
say?
people always want to hear our projections, or first of all, our projections, what we think is going to happen. But I think, like it's hard to talk about that without talking about what's been priced into the markets, what the markets are kind of saying is going to happen.
Yeah.
And then the second piece is how the markets generally react. So now that we're seeing the interest rates being cut, what does that mean for like people's stock portfolio?
Okay, so let's start with
Right? I feel
maybe
like that's a fairly
yeah. Yeah. So US, Canada, two different things happening. In Canada, we have the central bank, the Canada bank rate. And in the US, we have the US Fed. Both do the same thing. They set the interest rates and the monetary policy. So in Canada, the rate cut we're one notch lower than the US right now. We're at 4.50% in the US. They call it a range in the US, 4.75 to 5, but call it 4.75. So we're about a quarter point lower right now in Canada than in the US. We've had some cuts. There's a question there. I will get to that question in a bit. We've had some rate cuts. So there's a projection now. We've had a jumbo cut in the US. In September, they did what's called a jumbo cut. They cut by two cuts, so 50 basis points. When we talk basis points, we're talking about 1 basis point is 1/100th of a percent. 100 basis points is 1%. So if you want to cut interest rates by 25 basis points, that's 1/4%. Just set the tone here for the discussion we're having. So why does this matter? This matters because the more they cut interest rates, the more money we as consumers have in our pocket. It's a lever. They can just apply the lever. So the cheaper they make money, the more likely, the cheaper they make money, the less our debt payments are, right? The less our debt payments are. And the higher they make interest rates, the less likely we are to spend. So if interest rates are high, you can get a 6% or 7% term deposit at the credit union. You're not going to spend. You're more enticed to save. So they reduce interest rates to entice people to start spending, right? And to create more dollars in their pockets. It spurs the economy. The risk is obviously if you make it, if your monetary policy is too easy and you print too much money, then you create inflation. So inflation, interest rates, you bring interest rates down, you bring inflation down. So let's talk a bit about what's happened. We talked about the 50 rate cut. I think your question was what's going to happen the rest of the year. I forget. What did you ask me?
Two questions, two-part question. So first is, our projections or what we think is going to happen with interest rates over the next, year or so. How long is it going to take to get back down to our targets? And part two of that question is, now that we're kind of in rate cutting mode, how do we foresee this will have an impact on markets and people's portfolio in general?
Okay, so I'm going to share a screen here. This is the market expectations for the Fed fund rate. This is a little dated. It's a few weeks old. It's about a month old. And this is back when interest rates were at 5.25. 5.25. Since then, we've had two cuts. So we're now at 4.75. The month is now November. We're kind of exactly with what they were predicting back then. Now there's an expectations of almost two more rate cuts at the end of the year, another 40 basis points. So call it 1 3/5 rate cuts coming this year. So the market is expecting another 1.5 or almost 2 rate cuts this year. Now, the US Fed only meets 8 times per year. They meet in November and they're going to meet in December. So for them to do 2 more rate cuts, that would have to be one at each of the next 2 meetings. Is that for sure going to happen? I don't know, but it's going to be somewhere between 1 and 2. I'm quite confident on that. More importantly, 2025, what is the market expecting? The market is expecting something along the lines of another 4, 5, or 6 rate cuts for next year. So that's another full percent and maybe a little bit more into 2025. Now, the key thing with this chart is that most of the rate cuts are all fully priced in by the end of next year. So we're not expecting a ton of rate cuts into 2026. The cuts are going to happen now until the end of 2025. And most of them are happening, if you look at this chart, in the next 6 to 9 months. And I got another chart for this here. This was, again, a few weeks back, but we're expecting 250 basis points. We've already had 50 of rate cuts. And this is called loosening, when the U.S. Fed loosens their Fed policy. We're at the different rates, at the different meetings, what they're expecting. Does that make sense, Tania? This, what I just talked about, what the market is expecting?
Yeah, and I think our viewers understand that this is based on kind of what we're seeing in the markets when we talk about market expectations, right?
Yeah, and it's based on actually a little bit more than that. It's based on what we're reading, what we're seeing, the U.S. Fed plot. They do this thing called the plot, where everyone kind of, all the U.S. Fed members, they plot out their predictions for the Fed over the next 3 months, 6 months, 9 months. But there's a better indicator. There's a much, much, much better indicator than what we think and what the U.S. Fed is, and that is a live market. There's a futures market that trades on the Chicago Mercantile Exchange. It references compound averages of secured overnight financing rates. That's the SOFR. And it's basically like buying and selling stocks. So they buy and sell, just like we buy and sell stocks, they buy and sell the future interest rate at a specific date. So imagine you're a large company, you're a large Fortune 500 company, and you have, maybe you deal with interest payments, or you need to lock in money at a future date. Well, you could just risk that and take the risk yourself, or you could lock in a future interest rate on your capital. And there's a market for this. There's a lot of money that trades hands. And because there's a market, you can see the actual options and you can see the value. So if I look at today on the Atlanta Fed market probability tracker website, I can see that the expected rate for the June 2025 meeting is 3.4196. That's the projected interest rate for 8 months from now. And that is down. It's lower than it was in the past, but it's actually a little higher in the last month. Sorry to go on a tangent here, but I think I want to point out that in the last 3 weeks, 2 weeks, there's been some very positive data out of the US, specifically the job numbers and the GDP numbers, that are kind of telling people, you know, we might not get 6 or 7 or 8 rate cuts. We might only get 5 or 6. So there's now a projection. The line has moved about 1 rate cut less than expected over the next 14 months. So we have live, to answer your question, yes, we listen to the Fed fund rate. Yes, we listen to the plot. We follow the markets closely. And we also monitor the Chicago Mercantile SOFR market to see exactly what the market's expecting.
Okay, so part 2 of the question is...
I thought you were going to come to this.
Perfect. You've already got the slide up. Is what does that mean for the portfolios? What does that mean for markets?
Yeah, so there's a lot of different rate cutting cycles that have happened over the last, I guess, 100 years, but we've got 60 years here, or 55 years here since the 70s. This chart shows all the different rate cuts, both through a fast cycle and a slow cycle. And the 0 point in the middle of the chart is that first rate cut, that first cut that we just had in September. Okay, we just had the first rate cut in September. So what happens 12 months after that? That's what people ask. What happens after the market? What happens after the US Fed cuts rate? Well, in these 1, 2, 3, 4, 5, 6, this is what, 12 examples or something like that. There are 2 examples of a negative market 12 months after the fact. The other 10 are positive. So there are 10 positive. And if we look at the chart here on the side, we do see it's based to 100, but we see like in some of these, it's 130, 120. That means a 30% gain in the market in the following 12 months. You're also going to notice that the slow cycles, so when the interest rate cuts happen slower, are typically better for the market. The market appreciates it, recognizes it, that the Fed is in control. They're cutting snow. They're not panicking. And those blue lines are a lot more stable, a lot more positive than the red lines, which are highly volatile. So the answer to your question is it's largely positive. It's most of the time quite positive when we enter into a Fed rate cut cycle. And the second part of your question is, does it matter how fast they cut or not? It absolutely does. A slow cycle, a slower cutting cycle will be better for the markets historically than a faster rate cutting cycle.
Do you think that's also just part of that is kind of like it makes investors kind of less panicky, a little bit more confident in kind of how this all works, and so that just kind of creates a little bit more confidence in just the economy in general?
Yeah, I think so, and I think you're right. And I think it begs a bigger question, Tanya, which is, are there other variables that we should consider? And I think yes, because this is emotions, right? The market is an emotional thing. So you can't just say, oh, I've looked at 12 times and that means it's going to be positive. We know that's not the case. I'm putting up a chart here that shows very simply the performance, same chart as the last one, exact same chart as the last one, right? Except now what I've broken it down into two different things. When the economy avoids a recession, the top part, and the bottom part, when the economy enters a recession. Surprise! The market doesn't perform well when we enter a recession. Who would have thought? Who would have thought? Look at the valuable information you gained from us today. Now you know. I'm being facetious, but I'm trying to say that as predictable as this might seem to be, the one big variable is, are they going to manage to land this plane? I've talked about a soft landing before, and you've talked about it as well on global news. You're often on global news. We talk about this. Can the U.S. Fed and their monetary policy, can they land this plane? This plane is the economy. And instead of it crashing into a recession, can they kind of land it softly, not impact anything too much? People don't lose their homes, people don't lose their jobs, and you kind of recover after that. Is that possible? And that's the biggest variable. Because if they do, and by the way, the signs are indicating that we're getting a soft landing. So everything is pointing towards this blue chart at the top here, where we avoid a recession. So if we do avoid a recession, chart looks great. If we enter into a recession, you're probably going to see a stock market correction.
What do you think are the key things that have to happen to have that soft landing? Like, are there any markers or any, like, do we have any lessons from previous recessions?
Yeah, I think when you get panicky and jittery at the US Fed, I think historically that's when it's been bad. So same on the way up. Remember on the way up, they were very, very kind of panicky, and we ended up saying huge overcompensation and a ton of rate hikes real quick, and they weren't doing it earlier. So I think you want a US Fed that is transparent, right? We want transparency with the US Fed. We want open dialogue and discussion. We want a clear differentiation between the government, right? Whether it's Trump or Harris, excuse me. He's not running against Biden. Whether it's Trump or Harris, we want them to be clear that they're not going to meddle, MEDDLE. They're not going to get involved with what's happening with the central bank. They're going to quite simply let the central bank do its thing. And then the big thing is job creations. So that's a tough one, Tanya. That's a great question, because you can
think about that a little bit. But the other question that I was going to ask, and maybe this, might segue into the same thing, is, are there any, how should I say this? Is it a red flag if we see that, for example, Bank of Canada is, cutting rates earlier than the Fed? Is that an issue?
No.
What does that mean?
I mean, it's going to hurt our currency. So if we have much lower interest rates than the US, think of it this way. Less people will want to invest because their investments are going to earn less. So there's less appetite for currency conversion, less buying, dollar falls. So that's not good for the Canadian currency if we cut more than the US. But that's okay. We're doing our own. We have our own thing here in Canada.
Exactly.
We got to make sure we take care of our economy, and we have a very commodity-based economy. Natural resources, oil and gas, minerals, mining, water, lumber, that kind of stuff. So our economy is different than the US, which, they got technology, they got all sorts of stuff that we don't really have in Canada. So it's okay if we're struggling a little bit to do the soft landing. Our central bank, I'm hoping that our central bank doesn't just follow what Big Brother's doing regardless.
Yeah, they should be having their own factors to look at. Yeah.
Yeah, they do. They need to be independent. Our Canadian central bank needs to be fully independent. And that's what we want. Now, because they're so intertwined, because we have, 70%, like the economies are so intertwined, they're probably going to follow suit. Now, we're a little bit ahead of the US. Expect that we'll probably come down about the same, I would expect. Now, there's a great question here from Trish. Will the Republicans or Democrats be better for a soft landing, or does it matter? So this is a great question, and I think you hinted that we would be talking about this, Tania. So I'm gonna.
That was actually going to be the next direction to go into. This.
Thank you, Trish. Thank you, Trish, for asking that question. Yeah. I'm going to share a screen again, and I'm going to talk to you guys about what happened. And by the way, we can get back to U.S. Fed and stuff, but I will jump to this because it's a good question. So what happens in election years? First off, one chart every election year since 1952, I think. So every election year since 1952, you will notice there are 3 negative election years in here. 2008 was a bad one. That was the great financial crisis. And then the other ones are largely quite positive. Red is 2024. This is an older chart, but if we extend it here, we are at about, depending on which index you look at, the S&P 500 is up, I think, about 20 or so % this year. So we're somewhere in here. We're among the better performing years right now. So that's first off, I just want to show you most election years are quite positive. Next, I'm going to get into the historical pattern around election years to answer your question, Trish, because it largely doesn't matter who ends up winning. So at the top, you have your elections. This year, it's going to be on November 5th. And it's rebased right here in the middle to 0, to your election date, to 100, sorry. And the red lines are your Republican presidents. The blue lines are your Democrats. And the average is the gold line in between here. So I guess this chart is telling us that for the following 12 months, the market has performed better when Democrats are elected than Republicans in the year following the election. So, I mean, I guess that makes sense. They both, you could argue, someone might think this would be the opposite, right? Someone might say, well, wouldn't Republicans be better for the stock market because they're going to cut taxes and they're going to have more corporate growth? But the other argument is, Democrats are going to, fund more tax cuts. They're going to put more money in it's going to be more socialist, or they're going to spend the money a bit more, and they're going to put more money in everyone's pockets, which allows them to spend, which spurs the economy, which spurs corporations generally. So both arguments could be made. The reality of it is here, and I'm not making a statement in any way as to which way is better. I'm simply showing you the facts here. The Democrats, looks like it's about a 16% forward earnings. Republicans about 6. The average is about 11. So that means we expect over the next 12 months for it to be positive. Good news. This is not a time historically where the markets perform negatively unless you get a major recession again. Yeah. And then in Canada here,
that while the election is kind of leading up to the election, it kind of feels like people are generally don't know what's going to happen. They're a little panicky. Not much is happening. Not a lot, maybe as much trading volume, especially this time of year, that kind of situation. And then now you've got the election. Now whoever's elected is trying to make good on those promises, trying to keep their ratings up. So typically you're just going to see overall just better numbers,
positive.
Right?
Yeah. Positive. you said it. They're spending, right? They're gonna start announcing some spending. They're gonna, they're in a honeymoon phase. So whoever's elected is going to be like, hey, great news. We're doing this. We're doing that. We're doing this. Market's gonna love it. There's also stability, right? Because now we know who's elected. Although this year, I don't know. Hopefully there's stability in the fact that there's one candidate that is clearly elected. The Electoral College has spoken out and the other candidate concedes. That would be strong. That would be a good sign for the market. If not, there may be volatility there. In Canada, the bottom chart here, it's very similar to the US. Democrats slightly outperform the Republicans in US elections. Now, sorry, I'll pause there because I want to make sure I let you speak here. It's not
so that's showing that's showing the TSX there. Okay, so that is basically showing that it's almost the exact same chart in the Canadian markets based on US election results.
Yeah, for sure. And then if I keep going here, there's a couple more things that I wanted to show. So one is the election cycle year. We have talked on this show and on this channel about election year cycles. We've talked about how the third year of an election cycle is usually a really good year. We've talked about how the fourth year in an election cycle historically is a strong year. This chart here that I'm going to show you is the S&P 500 historically election cycle versus this year. So what we're seeing is that the last 5 election years, so let's go back to the last 10 or even the blue line shows every single election year cycle. So the fourth year of an election year cycle, you will notice that there's growth, right? There's growth. It's somewhat stable. You'll also notice a drop in October historically, and then a rally in November. This rally here is the seasonal pattern of the election bringing stability in November, and also coupled with the Santa Claus rally. People are just in a good mood around Christmas, so stock markets typically go up. And I do see there's more questions coming. I'll get to the questions. I'll just finish this point here. By the way, this top line here is 2024. I know we had the Chinese carry trade, unwinding of that Chinese carry trade, which was a wild month in the stock market. But look how quickly that unwound itself, Tania.
Yeah.
That's crazy. We fell like 12% in 2 weeks, and then we gained it right back. Mm-hmm. It reminds me of COVID a little bit, right? How quickly this market reacts to news and how quickly the markets in 2024 are quick to sort themselves out, right? It's not like if my dad were here, he'd say, back in the 80s, we had a ticker and, we would read about the newspaper and then we would read it on the Financial Times or Financial Post or whatever. I'm not making fun of my dad. I love my dad. I'm just, I'm making light of
but everything happens quicker, right? Because of technology and communication just is instant. And so we now have, we know exactly what happened in the Chinese markets today, last night, overnight. So it's just,
before it happens,
the cycle is just
million people digesting it, million people making opinions on it, million people talking about how it's a buy now, it's a sell by. You still get the emotions, but at least it's, it's a little different. This is a quick chart about the month by month. I think everyone knows that September, October, historically, there's been some crashes in those months. This is election year, right? This is the election year performance month by month on average during the election year. So November is historically a very strong month for election years. So that's one more thing I want to show you. Yeah. So hopefully that answered your question about the election. And I think there's another question here about elections. Simon here is asking a question. I'll put it up here.
All right.
Any anticipated fallout from the U.S. election, Milton, and the Middle East? So I think I've covered this in the past. Yeah, no, they're definitely the U.S. election. I think we've covered it. Hurricanes, as much as it's devastation and it's a lot of losses and it's very unfortunate, surprisingly or not surprisingly, they don't move the market that much. Or if they do, it's generally brief. And then there's usually a brief recovery. Most of the losses are going to be they're going to be borne by insurance companies and the government.
It'll be
And again, I'm
slower,
not making
slower to have an impact, especially if it's a
and I'm not
regional
making an
or
opinion as
localized.
to it's usually like there's a decent amount of spending that happens afterwards, and it's actually not a huge mover of the market, surprisingly. The Middle East is definitely a question mark, absolutely. Anytime you have global macro events, but I mean, we've gone through like the last 100 years, 150 years, if you want to go further back, we've had 2 world wars. We've had, I don't know how many global crises where, presidents are assassinated and, countries are taken over, and it sucks. It's terrible. And again, I'm not making an opinion on it. I'm simply stating that through that, corporations typically make profits, and the companies are going to be worth the discounted value of their cash flow at the long term. Now, if this global conflict ends up having serious impact on GDP here and in kind of other areas, it could impact short-term or medium-term the market. But as of now, I don't think it has, and it doesn't look like it will in the immediate short term. I don't know if you have a comment on that, Tania.
Well, all I would say is that typically what happens is it'll have an impact perhaps on a specific sector, if certain trade routes are affected or, things like that. So you may see kind of short-term impact on, whether it's energy or these kinds of things, right? Specific commodities, depending on where that's located geographically and what kind of sectors are being impacted. But it's kind of regardless of what a tragedy sometimes these situations can be. It's kind of amazing how resilient kind of the world economy as a whole, how quickly those can kind of rebound.
Yeah. Largely they shrug it off, unfortunately.
But we will see like if it's Middle East, we may see like oil prices being affected and things like that.
Oh, for sure. Any commodities, that'll for sure move. I'm going to pop a question here from Jeff. My wife and I have several accounts with one broker, RSP, RIF, TFSAs, trading accounts, US and Canada. How should I approach sector allocation? Thanks, Jeff. So I have to be careful here to give you advice, Jeff. I don't know your personal situation, but I can tell you that overall, your asset allocation, is there a line across my face of shadow? There is, eh?
Yeah, you've got a sunbeam there.
Should I move that? I probably should fix that, eh?
It doesn't bother me too much. I see I've got a little bit of a sunbeam in my back office here too, but it's not on my face, so I think we're okay.
Where's that light coming from? It's over there.
I don't know. Anyways. Maybe it's like a reflection.
Yeah, it's something. So
it's not too distracting. It's not on your face. It's like on your neck.
Where is it? Okay, so let's get back to the question, because that's the most important thing. Producer Diego is laughing at me right now. I can sense him. I guess the answer would be, first off, if you were a prospective client coming to me, Tania, what would we ask?
Well, first, before I even start talking about sector allocation, first I would actually talk about asset allocation. So I know I'm not answering the question, but you can't put the cart in front of the horse. So a lot of that is going to depend on different accounts, and in terms of sector allocation, well, one thing that we can say without really knowing your situation is diversification is going to be key. So of course, I'm not giving very good answers here, but I think I'm giving
but we have to be careful,
right?
We have to. I would find out, like, how did you react in 2008? How did you react in 2020? How did you feel in 2022? How did you feel in August this year when the market fell 12% in 2 weeks? If your exposure is 100% stocks, that could be tough to stomach. How did you feel? The answer is I was fine. I always have 100% stock. Great. Maybe we're dealing with a kind of a max growth, but maybe it's a 60-40 portfolio. If it's a 60-40 portfolio, we believe in alts. I've talked about this before. We have less volatility than most in our portfolios because we have alternative asset class, much like pensions do. We manage money like the largest endowment funds on the planet, and they have an allocation to private real estate, infrastructure, farmland, music royalties, storage, all that stuff that is agnostic to what happens in the stock market. I would say, do you have any of that? Then with respect to sectors, your fixed income, if you own fixed income. Yeah. And then you go into sectors. You don't want to avoid, I don't know I would definitely own some growth. You cannot avoid that. And if you're avoiding growth, you're doing yourself a disservice, because those are the companies that are growing their earnings at the fastest rate. Yes, they're trading at a higher multiple, but you want to be on that on the side of the momentum trade, definitely. Part of
I
your
think
assets,
we
you
have
want
to be careful with sector allocation too. Sorry to interrupt you, Rob, but you've got to be careful with sector allocation too, that we're not getting into a situation here where we're speculating and actually, trying to somehow game this or to time this. And for, obviously you do want to have different sectors. You want to have, some value, some growth, and everything from, retail and financials and technology and, commodities. You kind of want to have a little bit of everything. But how you would approach that, well, a lot of that is going to depend on your specific situation. It's going to depend on, your risk tolerance, all of that. But yeah, you really have to be careful when you're kind of digging deep on there, because here's the thing. If you don't get the overall allocation right, just like the parts that are, that are going to have the most impact on your portfolio, on, your experience as an investor, like whether or not you're sleeping at night. So I would focus first on making sure you're sleeping at night, making sure that you're kind of in the right overall allocation. And then once it comes down to kind of sectors, my advice would be to avoid speculating on sectors necessarily. And yeah, you can make some smart moves by trying to have some diversification, but be very, very careful about saying, oh, well, this is happening in the economy, so I'm just going to avoid this whole sector, or I'm just going to go all into one sector. That's something that we would say is a red flag.
I got an email question overnight from Paul. Question talks about, why is the market hitting new all-time highs? What's driving this market to new all-time highs? And I can address that question, I guess. The answer in short is earnings. The answer in short is earnings and positive momentum around the economy as a whole. Because at the end of the day, we've talked about this in the past on this many times, but the market will be, a stock will be a reflection of its current cash flows and its projected future cash flows discounted to today. So if you have a company that's expected to make $1 this year and $1.10 next year and $1.20 the year after, you use a discount rate, you bring it back to today, and that's the valuation of your company. Obviously, there's other ways to do it, but largely, this is how most people evaluate. And what do they use for that? They use a multiple of earnings. And what is the multiple? The base in there is earnings. Earnings are the most important thing, because if we're buying something, and if you and I were going out and buying a manufacturing company or a plumbing company or whatever, we'd want to know, is it profitable, right? Is the company profitable? Same thing we do when we buy stocks in your portfolio. Is it profitable? And then how much profit? How much is it growing? Is it in a sector that we expect to see more growth? How's management? But the first variable is earnings. So there's maybe a misconception around how earnings have done. So I'm going to show you a chart here. This is earnings since, I guess, the beginning of 2022. This is the S&P 500. Next, so the forward earnings per share. It's the highest it's ever been by a long stretch. No wonder our market is hitting all-time highs. Right now, the S&P, the TSX, the NASDAQ, the Dow, they are all at or near all-time highs. And this is why, in a nutshell, we are seeing the earnings of all of those companies as a whole, as an aggregate, make new all-time highs. Now, why is that happening is a separate question. I think there's more confidence in the market. People are spending a little bit more. Interest rates are coming down. There's technology is bringing savings to some companies. There's a whole bunch of reasons why that's happening, but largely they were beat up here, right? There was a period of time where we weren't expecting corporations to be profitable, and now, boom, we're recovering from that. If you extend this chart further, I promise you, it's a reflection of what the S&P 500 looks like as a whole. It's the biggest correlation that exists.
I love this question, but the problem is it's going to beg the next question, which is, should, everyone always says, buy low, sell high. So, if everything's always at an all-time high, what do we do? I get that
Yeah, that's a
question all
good
the
question.
time.
This is another chart here that talks about US corporate profits. And this is IVA is the inventory and CCA is the credit allowance or something like that. But anyways, it's the same chart. It goes a little further back. And I will answer your question, Tania. This is corporate profits 3 years. This is 20 plus years. You're seeing that chart, right? You're seeing just the growth and what happens to stocks. They reflect that. But your question was, should we not, like, can you remind me your question?
Well, seeing as we should buy low and sell high, at least that's what everyone feels they've always been told. How do we go about buying when we're always hitting all-time
When the
highs?
markets are at all-time highs. Yeah. Okay.
Mhm.
I got a chart for you on this, actually.
Because I feel like that would be the follow-up question to this, like, first of all,
Yeah.
what's driving
So
all-time highs, and like, what do we do now?
before I do that, I'm going to ask everyone who's watching to think about this question for a sec. If you had the choice, everyone who's watching, you're going to play this game at home with me. And
Oh, I
anyone
love
who's
this.
listened to me in the past, they know the answer already. But I'm going to ask you, if you had the choice of investing, pick any random day or investing every single day when the market hits a new all-time high or any other day. Okay, so either you're investing when the market hits an all-time high or any other day. Which one would you choose to invest in? Which one would have the higher forward returns after that in the future? Well, I think you know the answer now because I've let it into you. But the market actually performs better when you invest at all-time highs. On the right here, there's a chart from 1988 to December 31st. If you invest on any day, what your returns look a year out, 11%. But if you invest at a new all-time high, 13%. Your 2-year number is 25 versus 28. Your 3-year number, your 5-year number. The punchline is you're better to invest always, constantly, equally. You're always better to spread out your investing if you can than you are to wait for a drop, because we know what happens when you wait for a drop. I talked about it before. The other thing that's really interesting about this chart, Tania, is that 30% of the time, that all-time high will act as a floor. In other words, the market will never go lower than that. The market will never
Crazy
go
to think about
lower than that.
30%.
Yeah, a third of the time when you
Crazy.
see a market make an all-time high. So if you go, oh, I'm just going to wait for it to come back down. Well, 2/3 of the time that will happen, but a third of the time it's never. That's why people who make, covered call strategies, or anyone who buys a range, trades a range, the day traders out there that are promising guaranteed returns. All you got to do is buy my program. It's $500 and you're going to know how to trade FX and crypto and currency and stocks, and just pay me $50 or $100 or $1,000. I'm going to give you the secret to day trading. BS. Sorry to be loud and in your face on this, but that you can't do it. And here's why: because this is what they end up doing. They end up thinking that they're just going to trade a range, but in reality, the stock market humbles you, and the stock market doesn't believe in your range, right? And a third of the time is not going to make a newer low than what it just made. If you look at this chart here on the left, 80s, 90s, 2000s, 2010s, 2020s, in pretty much every market cycle, there's a period of time where the market will not come back down. So if you're just waiting and waiting, 6.6% of the time, the S&P 500 closes at an all-time high, right? Or 1 out of 16 days.
Either the companies in the S&P 500 are just going to, continue to grow, or they'll go out of business. So it makes sense that the floor would just keep.
Yeah,
right?
That's a good point. Yeah, absolutely. That's a good point. So anyways, to answer that question about whether or not market's at an all-time high, do I invest today? The answer is yes. Now, there can be a caveat to that, right? If you get $5 million today because you sold a farm or you sold a business and you get all of it today, do I put all of it in the market today? Well, that's a separate question, right? Because now we're talking about market timing risk, right? We're talking about the risk that you happen to invest at a time where the market falls 20, 30% after. We want to protect against that risk. So we do what's called legging in, and we reduce that risk. We invest over time, but we're not going to avoid investing in the market just because the market's at an all-time high. This is proof of why we shouldn't do that. So hopefully I answered that question.
That was a great answer.
Forcefully.
forcefully called out the BS. I love it. I love it. I feel like we should say that more often. If someone wants your money to teach you how to time the markets, like just like run the other way. Like,
Oh my God. Is there a bigger red flag than that? Is there a
yeah.
bigger red flag on the planet than someone telling you that they have the secret sauce? They know how the market works and they're willing to give it to you for $50 or $100 or $500?
In an
Come
age
on.
of all the information being completely out there, as if they somehow have information that no one else in the world does, even though it's all
What
public.
you need, and the reason we have experts, the reason you deal with a portfolio manager, you want someone to make sure your asset allocation is good. You want someone to tactically you want someone to remove the emotion from the process. You want someone to do the financial planning. You want someone to access alternative assets, which you can't have access. But if someone comes to you and says unequivocally, I, Rob Tetrault, know exactly when the top is in the market and I know exactly when the bottom is in the market, that's a red flag.
Well, and the other reason you'll want a portfolio manager is so that they can be making those day-to-day decisions, and instead of you kind of hemming and hawing, oh, is the market going to go up tomorrow or down, or should I do it today or should I wait for tomorrow? Or, this is when you're a pro, these decisions are done via analysis and via experience, and those are not fun decisions to make when you're dealing with your own portfolio.
Yeah. And the other point about investing at all-time highs is it sucks missing. You've seen this chart before probably, but missing the best days in the market. It's not good for your portfolio and for your wealth if you happen to miss the best days. And lo and behold, some of the best days happen at the all-time highs, right? So if you're missing those days, I'm just going to show you a quick chart. So they definitely happen in good markets, but they also happen in bad markets. This one was a little surprising to me, and I wanted to show it to you because 50% of the best days of the year happen during a bear market, right? So this is the other part of the debate. So clearly you want to be fully invested even when the market's high. But when the market's low, sometimes we get this question, shouldn't I just pull out now, Rob, and just wait for this whole thing to settle down? And then we can get back in once the market has calmed down and everything's okay. Does that make more sense, Rob? And the answer to that is this chart, right? I can't guarantee you that I'm going to pick the bottom perfectly. We can do tactical asset allocation where we can shift out of some sectors and out of some fixed income and into stocks at or near the bottom. We've done that. We try to do that. But if you happen to miss half of the best days of the market happen right during a bear market. So, argument.
Yeah, I really like this. I like this chart. This surprised me a little bit too, but it makes sense. And I think this brings us even closer to essentially being able, this is part of our job, right? Is part of our job is kind of taking the decision burden, the emotional burden that comes with all of this on behalf of our client, right? And whenever I see a chart like this, I'm like, it makes me think that, I think what most investors should focus on is deciding, not timing, not do I want to be in the markets, do I not want to be in markets? Like, do you want to be invested, yes or no? Okay, I would assume that the answer is yes if you have a portfolio manager. And then once we actually have a conversation with our clients, figure out asset allocation, figure out risk tolerance, then guess what? You don't have any more decisions to make. You get to just sit back and say, look, if my asset allocation is correct, and I've already decided that I want to be invested, then that's it. There's no other decisions to be made as long as we have covered all our bases and we figured out what your risk tolerance is. We figure out, what kind of returns you'd like to have for the amount of volatility that you're willing to tolerate. And so for me, I always feel like it's making things harder as an investor when are always feeling as though you have to make another decision, always have to make another decision, always have to make another decision. And I know I tend to talk a little bit more about the soft emotional stuff about investing. Sorry, Rob.
No, this is valuable.
All the statistics and, the charts and all of that. But when I see a chart like that, I think, okay, well, how does this fit in to like a regular investor, like someone who would be one of our clients or something like that. And to me,
That's why we're a good team.
Okay.
That's why we're a good team, Tania.
To me, that's what the chart tells me. To me, the chart tells me, look, don't stress over these other decisions like timing and all of this. Like, you're invested. This is good, So yeah, that's the way that I see it when I see a chart like that.
Yeah, I agree. And obviously you're going to have an open dialogue with your team about planning and life changes and, I inherited money or I sold a farm or whatever. And that is the relationship that you should have with your advisor. It should be, hey, I'm thinking of buying a condo. Hey, I'm thinking of selling the farm. Hey, I'm thinking of starting an RESP for my kids. Hey, I'm thinking of retiring. Those are the discussions you should be having with your advisor, not, hey, should I own more NVIDIA? Hey, are we timing this market thing? Hey, are we, those are, I would argue.
100%. Yeah.
Anyways, speaking of conversations
some people love, to like look at the data and,
and I'm not saying that you can't be involved. I'm not saying you can't be informed, and you as much as you want to learn about this stuff, you should learn, because information is power and knowledge is valuable. Right. And anyone who tells you just shut your eyes off and never look at, it's important to be knowledgeable and aware and know what's happening. And by the way, keep the questions coming. We got another 10 minutes or so. So we do want to keep the questions coming. Thanks everyone for tuning in across all our platforms. Small caps, EV sector, dip buying in October. So I pulled up the, I think this question is, should we be buying the dip in EV small caps? So the EV small caps are a subsector of EV. This is the EV ETF. iDrive, the US one. There's other ones, but this shows roughly, if we get just into the chart here, what's happened over the last 5 years. So you might recall the EV boom or the bubble that happened in late 2021, early 2022. By the way, anytime you see a subsector that is not profitable, that is, everyone's talking about it. My dad would always see your cab drivers talking about it. Your cousin who you haven't seen, who you only see at Christmas, who never talks to you about investments, starts talking to you about a subsector that isn't profitable. You're usually close to the end of a bubble bursting. And I remember thinking that about EV, and especially if we were to pull up so anyways, it kind of burst. It was at 50, 60 bucks. It kind of fell. And now it's starting. I think what this comment is saying is, this chart looks like it might be trying to start to recover here. I would just caution you this. There's a lot of these patterns. Lower lows are generally not good, right? So there was a low here, then there was another lower low, another lower low, another lower low, lower low, lower low, lower low, lower low. It is tough to pick this lower low bottom. And I do think that EVs they're part of the future. We all know that. The problem is this consolidation. Remember the cannabis bubble, Tania? Do you remember this?
Yeah.
Like everyone buying cannabis. I went on BNN and I said, whoa, pump the brakes. These companies that aren't profitable, they're not worth more than, the Royal Bank of Canada, who just made, X many billions of profit last quarter. Like, that company is not more valuable than that company. And sure enough, the entire thing collapsed. And now they're in consolidation mode. All these small companies are being bought out and restructuring, and they got all this debt, and some of them are going bankrupt. And I'm not saying that's for sure going to happen to EV, but there's a lot of players in EV, and they're not all profitable. And I'd be careful here if I were you. Let me just put it that way. It's not something
and even more careful on individual names. Because if it does end up being kind of like a consolidation type of situation, well, how do you know who's going to end up on top? You just don't.
Yeah, you really don't. So anything else you want to ask me, Tania, or you're curious about, or anything else you want to share?
Well, I think we covered, we're getting a lot on, we covered elections. I'm looking at my notes here. Actually, I think we covered a lot of the stuff that we wanted to.
Yeah, I think so too. It's been a very efficient use of our time for sure, and hopefully our viewers' time. Hey guys, if you're watching here, by the way, feel free to follow my running channel if you want to learn about my running channel. It's what is it called again? Run with Rob CMV. Run with Rob CMV is my running channel where I talk exclusively about running and the races I do. I got
and then you get to meet
coming up.
our other sibling, Charles.
Charlie.
Charles is,
Yeah.
is
We have
Charlie's
a
on a lot of the, so that's really cool.
Yeah, my brother and I have a running podcast where we talk about our runs and our training, and some neat stuff coming there. Follow us on YouTube, this channel. Our TikTok account is kind of cool. I think there's a lot of really neat stuff. I go live from time to time. Instagram, obviously follow us there. Twitter, follow us there. YouTube.
I like that you mentioned the YouTube, because there's just so many good resources there. And there's not going to be like, anyone telling you that they're going to teach you how to time the markets on our YouTube channel. So. We have no like, I have nothing to sell you on a platform or a trading thing, or I'm giving you free information. Take it if you want it. I think it's very valuable information. I manage $1 billion. We manage $1 billion of assets. That's a real chunk of change. Not many people in Canada manage $1 billion of assets on the retail side. So we are real portfolio managers managing a successful practice. We have 15 employees here, and we're choosing to give you as much free information as possible because we believe there's not enough being done for financial literacy. We believe there's not enough information out there to avoid scams, and we believe we're helping people. It's part of what we want to do. And we also believe that if someone likes what they see here, they might go to speaktorob.com. They might book a no obligation consultation like Jeff. If you're unsure, you talked earlier about your asset allocation, your sector allocation. If you're unsure, Jeff, you can go to speaktorob.com and book your no obligation consultation to chat with us if you'd like. No obligation though. And who knows, you might get Tania, you might get me. It depends. You might get Remy also. We'll leave it at that for today then. Yeah. Okay. We're not seeing any other comments or questions. I think that's
we're coming up on the hour here. So I do want to respect people's time. They got to get back to work or whatever they're doing. And the boss is upset. What are you doing? Oh, I'm watching this video. I swear it's important. Thank you guys for tuning in. Tania, thank you. It's always great seeing you. All right. We'll see you guys.
Have a great week, everyone.